Did you know that most businesses fail because they don't understand their finances? Don't be one of them. But I know financial statements are intimidating because of all the jargon. I mean, who actually likes looking at these numbers, right? I do, but that's besides the point. Hi, I'm Brad. I've condensed 15 years of financial knowledge down into this video. So put down that boring textbook because this is the only video you're gonna need. Let's talk about financial statements. There's three general ones. Here's the thing to understand right off the bat. They all work together. It's like a circle. All the numbers flow around all three statements. First, there's the profit and loss statement, also called the income statement. It's like a snapshot of the performance of your business. Then there's the balance sheet. That's like the stuff the business owns and any kind of debt the business owes to somebody else. Then there's the statement of cash flows. That's tracking all the money going in and out of the business. So think of them working together like this. When you get paid by a client, that money hits all three statements in different ways. Let me show you how. Let's start with the profit loss. You're familiar with the first part, sales. You bill a client and they give you money. It's simple, right? Generally, we call that top line revenue. Now here's the tricky part, cost of services. This will be the trickiest part of this statement. Cost of services is just what you spend to deliver your services to your client. If you're in the medical field, when a clinician is treating a patient, doing the CPT codes, injections, physical therapy, all those things, that is what the client pays for. Everything else around is a support. It's an operating expense, like the building that the clinician is treating the patient in. That is an operating expense. And we'll get to that in a little bit. But the clinician doing the service themselves, the wages, those are cost of services. It sounds simple, but people mess this up all the time. Let me give you a real example. Say you're running your business and you've got employees doing lots of service delivery. Your job is marketing and taking sales calls. So the question is, does your stuff go in cost of services? No, because you're not fulfilling deliverables for your client. You are trying to get new business. Your employees are the ones making the content, the ads, editing videos. They're fulfilling for the client. That's cost of services. Now, let's talk about operating expenses. This is all your hero support costs. So you think of cost of services as the heroes of the business. They are doing what the business offers, what generates money. But the operating expenses, those are hero support. It's everything you need to support delivery of your main service. We're talking about sales team, admin team, advertising, QuickBooks, rent, utilities, the accountant fee, telephone bills, etc. Now that we've discussed different types of expenses, we can talk about types of profit. When you take revenue and subtract cost of services, you get gross profit. Gross profit is the amount of money you make from providing your services. After you have your gross profit, you subtract your hero support, your operating costs, and that gives you operating profit. Below all that, there's more income, but it's usually minor. It's other income. This can be interest the business generates in the savings account or dividends from asset holdings, and also more expenses below that. And that's your other expenses like depreciation or amortization. And you've got net profit, the big indicator of your business performance, and typically what you're taxed on. Now, the next statement is the balance sheet. It's the stuff in the business. It's called the balance sheet for a reason. It's always in balance. And here's the simple math. It's assets, the stuff, equals liabilities, what the business owes people, credit cards, lines of credit, accounts payable, plus equity, what you as the business owner own from the business. Past earnings and contributions. With basic algebra, what you own in the business is your assets minus liabilities. Now here's the real deal of the business, the cash flow statement, the one everybody ignores, even though it's super important. Cash flow is the life of your business. It's cash coming into the business and cash going out of the business. That's it. But cash can come into the business via a variety of sources, and that's what the statement does. It tracks all that cash that can go in and out of the business that doesn't show up on the profit loss statement or moves through the balance sheet cryptically. Because here's the thing people miss. You can have negative profit in a year, and it might actually be a good strategy, something you've done with the business for a purpose. And your business could still be cash flowing like crazy. Getting that whole picture of the business is what you need all three statements together for. Listen, I know this is super complicated stuff. Maybe it made your eyes glaze over a bit, but knowing how these statements work together is incredibly powerful for your business. because it gives you the whole picture. And once you've got money flowing into these statements, you need to know what to do with it. If you want to learn, watch my video on the revenue router system, and you can learn the exact system I use with my clients.